was a transitionary phase for us because we were moving from lower volume into higher volume with the addition of those tanks, CIL tanks. We also changed from carbon in pulp to carbon in leach, so we saw some lockup. What was unexpected was the fact that we had some unscheduled maintenance at one of the higher grade circuits, which obviously impacted on the actual gold throughput. But we're very pleased with the volume throughput and the fact that we could maintain our cost per ton profile relatively flat. We did take a bit of surplus cash into the period, and we spent just on 130 million in capex, dividends, debt repayment, and we still managed to, I think, finish with enough after finally having gotten back our VAT reimbursement. We ended up with enough to be able to pay our dividend, our 12-cent interim dividend. Your strategy with a resource like this is informed by your resource and your technology, the combination of the two. And we needed to see what this infrastructure was capable of before we could really be too ambitious about what we want to do next, what the next step was going to be. Now we know what sort of metallurgical efficiency we can expect, and we can now start plotting the feasibility of some of the other dumps that we have that are within reach and that we can process through this plant infrastructure. So what we're really looking at now is what are the other add-ons that we need to make in order for us to bring this to account, to really realistically bring this into a future life of mine plan. So conceptually, we're looking at what can we do with a resource that stabilizes at 0.26 gram a ton, between 2.25 and 0.26 gram a ton. What is the volume profile that we require? What is the volume capacity of our plant and infrastructure? To which extent do we need to take it up? And one of the scenarios, for example, that at this stage looks quite interesting, quite attractive, is one in terms of which we mine 2.7 million tons at 0.26 gram a ton, and then it'll cost us just on 450,000 rand a kilo, kilo of gold produced. So at today's gold price, that's a healthy margin, but obviously you want to see just how this plans out. So the next 24 months or so we'll be spending on our feasibility studies, looking at what sort of expansions are required. We have a fair idea what capital is required. We need to see just what the cash flows going forward are going to look like, because we do want to maintain a robust approach to distribution of dividends, and then see what the investment horizon also looks like in order for us to seamlessly go into the next phase after the expiry of the current 7-year life of mine plan.